Welcome. As of 10 to 17 a.m. on February 4th, 2026, Strive Inc. is trading at 61 cents per share, down just over 11% on the day. At first glance, this kind of move might look like normal volatility for a stock tied closely to digital assets. But today's price action is being driven by something much deeper than short-term market noise. The real pressure on the stock comes from growing concerns around Strive's capital structure and an upcoming corporate action that many retail investors are underestimating. While the broader market may dismiss this decline as another high beta swing, the underlying mechanics tell a more complicated story. Many retail investors expected the recent acquisition of Semler Scientific and the aggressive buildup of digital treasury assets to put a floor under the stock. Instead, the market is reacting to the looming 1-for-20 reverse stock split scheduled to take effect at 12:01 a.m. on February 6, 2026. This reverse split is a defensive move aimed at keeping the stock compliant with NASDAQ's minimum listing requirements. Historically, markets tend to sell off ahead of reverse splits, viewing them as a signal of structural weakness rather than strength. That dynamic is clearly playing out here. Strive has positioned itself as a corporate treasury company, openly modeling its strategy after firms like MicroStrategy by using its balance sheet to accumulate large amounts of digital assets. At the same time, the company recently announced the successful retirement of $110 million in debt inherited from the Semler acquisition. Despite this progress, the common stock remains under heavy pressure. That contrast raises an important question. How does a company holding more than 13,000 Bitcoin and fresh from a $225 million capital raise struggle to stay above $1 per share? The answer lies in dilution and capital stack priority. The issuance of SADA preferred stock adds a powerful layer above common shareholders, giving preferred holders priority in dividends and liquidation. While this improves balance sheet stability, it also increases risk for common equity holders. Short-selling data helps explain today's downside momentum. Nearly 16% of the float remains sold short, with a short volume ratio hovering around 60%. This suggests a large portion of today's selling pressure is coming from institutional traders positioning ahead of the reverse split. Borrow rates remain low, around 1.2%, indicating there is no shortage of shares available to short. When borrowing costs are this cheap, it encourages sustained downside pressure because the cost of holding a short position is minimal. Investors should monitor changes in borrow fees and fails to deliver data closely. Historically, Strive has experienced spikes in delivery failures during periods of extreme volatility, sometimes reaching hundreds of thousands of shares. These events can signal liquidity stress or coordinated short-term pressure. Looking at institutional behavior adds another layer of insight. Despite mixed retail sentiment across social platforms, firms like Vanguard and UBS have maintained or increased their positions in recent filings. Co-founder Vivek Ramaswamy also continues to hold a meaningful stake, even after dilution-adjusted ownership. Strive's business model has changed dramatically over the past few months. Originally focused on challenging ESG and DEI mandates through its asset management products, the company has evolved into a dual-purpose entity. It still manages over $2 billion in exchange-traded funds, but its primary growth engine is now its digital asset treasury strategy. The challenge is that the market is heavily discounting the operating business. While management expects the asset management arm to approach break-even later this year, acquisition costs and ongoing capital requirements have kept the company unprofitable on a GAAP basis. This disconnect between expectations and reality is central to the current sell-off. Investors want Bitcoin exposure to translate directly into share price appreciation. Instead, the reverse split highlights just how inflated the share count became before a reset was unavoidable. The next major catalyst will be earnings on February 9th. Markets will be watching closely for guidance on fee growth, capital allocation plans, and whether the company intends to prioritize digital asset accumulation, acquisitions, or further debt reduction. From a tactical standpoint, the days to cover ratio sits just above 1 day, meaning shorts could exit quickly if positive news emerges. However, that also limits the potential for a sustained short squeeze unless borrow costs spike sharply. Options activity is another key indicator. A surge in put open interest heading into the split would suggest sophisticated traders are positioning for post-split downside, a common pattern in microcap stocks. Management's decision to retire more than 90% of Semler-related debt within weeks of closing was a strong signal of discipline. CEO Matt Cole is clearly trying to align long-duration assets with long-term capital rather than short-term leverage. The risk is that preferred stock dividend obligations could become a drag if the asset management business does not scale fast enough. Investors must decide whether the current discount to digital asset value represents a rare opportunity or a warning about execution risk. After the reverse split, the stock will technically trade back in double-digit territory. While this is mostly psychological, it may open the door to institutional buyers restricted from owning sub-$5 stocks. Ultimately, Strive represents a high-risk, high-reward restructuring story. The company has cleaned up its balance sheet, expanded its